Welcome to another edition of Marriott MBA Today. Today I have with me Professor Steven Thorley, part of the BYU Finance faculty. Professor Thorley, thanks for making time. I know you're busy, but we are going to talk about your favorite topic today, and that's the BYU Silver Fund.
Oh, well, good.
So Professor Thorley, tell us a little bit about the BYU Silver Fund. When did it start? By whom and why?
Well, the word silver needs to be explained because you could think it was investing in silver. Silver is the last name of a family, and they donated this money to BYU all the way back in 1984 to the BYU MBA program. They donated some money specifically so students would have a portfolio to manage, and it's been here ever since.
So have you met them, by the way?
No, I have not met. I've not met them.
Okay.
So yeah.
Wow, great. So how do MBAs get into the program? What do they need to prepare?
Well,
what do they need to do?
So it's for second-year MBAs.
For second years, yeah.
And what they would need to do is get good grades in the first year. It'd be nice to take MBA 622, which I teach.
Okay.
But the biggest thing would be to do well in finance and related classes. And then the second thing would be we want to get people that are passionate about the markets, that have some ambition to actually be in asset management when they graduate.
Yeah.
Probably the third thing is people that get along with other people. That is, it is a team, very much a team effort.
So collaboration environment works.
Very much so, very much so. And I'll just mention that it's you don't actually have to be an MBA student within the Marriott School of Management. You can, other graduate students, specifically Masters of Accountancy, can do it as well. It's not as common, but it's possible. Okay.
So what is the decision-making process on a recommendation? What do this...
In March of the first year, there'll be an application, a formal application that you make to be in Silver Fund or in Cougar Capital, also as RATAs. Yeah. You'll fill out that application. In the end, I'll look at it with some of my fellow professors, and we'll make decisions. The charter says there can only be 12, so there's a maximum of 12 students. It says 10 to 12, but at 12 is the most.
Okay. What about the decision-making process on analyzing the securities? Or the different financial instruments? How do they make a buy, sell, or watch recommendation?
You could speak to that probably better than I. One of the aspects of it is it's very much turned over to the students. In fact, I always like to sit back.
So you're hands off.
Yeah, I'm not going to say anything here. I'm not going to do this. That's for a number of reasons, but I don't even, as you know, I don't even know which ones they're going to buy until after the fact. So a student will present. They'll present to the group, the Silver Fund group, their analysis of a particular stock, full-blown what we call DCF models, discounted cash flow models. What is the business? What's their strategy? Are they global? Are they domestic?
So it's a fundamental analysis of the company.
Yeah.
What about technical analysis?
We don't do that very much. There's a history there, but it's fundamental analysis and primarily what we call value as opposed to growth, which we might say Gladys is he's our growth personality in the Silver Fund group. Yeah. But value fundamental analysis and very benchmark oriented. So the Silver Fund is part of the larger university endowment, which is 1,000 times bigger than the Silver Fund. The Silver Fund is $2.6 million. The stock fund is.
The equity fund.
The equity fund.
And then there's a fixed income fund as well.
Right, there's a fixed income fund. And this is all done in the context of this large institution, Brigham Young University, which has many fund managers. And so one of the things that's important in that context is benchmarking. That is, it has to be invested in stocks, and we measure performance against the S&P 500, the Russell 2000, which is a small cap index. It's also primarily
and
domestic.
what's that percentage today? So it's like
currently we are benchmarked against the 80% S&P 500,
so more large cap and
more large cap, and 20% Russell 2000.
20% Russell. So let's talk about the performance of Silver Fund. How has it done throughout the years? We do have a graphic to show which shows a 15-year performance of the benchmark, the fund itself, and the the positive or negative return, what we call the alpha. But any insights there?
Well, there's a number of ways to think about performance. One perspective that's interesting is that when this was started in 1984, it was $200,000, and now it's 2.6 million.
Yeah.
Now you could do the math on that, but there's been a lot, a lot of things happened over the years. If you look at this graphic, the last several years, what we're looking at is a bar chart where we've got the market return, the benchmark return, then we have the Silver Fund return, and then the difference between those two is the lighter, smaller bars. And you can see that difference between those two, which we call the alpha of the fund, has been positive the last 4 years.
4 years, yeah.
And that's our primary objective, is to not just get the market return, but to beat the market. To beat the market, yeah. By as much as possible, and as consistently as possible.
We're an actively managed fund.
It is very much actively managed. Which is another dynamic that's interesting.
So
because
cash is discouraged in
we don't want any cash. It's got to be fully invested.
Yeah.
And in academia, we preach a lot about passive investing and can managers really beat the market. But in this context, that's what we're asking.
The index instruments, ETFs.
We're asking the students to beat the market, and no excuses.
All right. No whining on our part.
That's right.
All right. Well, thanks so much, Dr. Thorley. So one last question I had: what have been, because this is an ongoing process, obviously, what have been some of the headwinds and tailwinds that the Silver Fund has experienced this past year, or this past academic year?
I suppose we ought to interject here that when we talk about headwinds and tailwinds, one of the first things that comes to mind is interest rates. But in addition to this equity fund, let me also mention that Zions Bank allows this same group of students to manage a portfolio of bonds, a $5 million bond portfolio. It's actually Zions Bank money. They just let us manage it for a 6-month period, October 1st of one year to March 31st of the next year. So it really depends on whether we're talking the stock fund or the bond fund.
That's right, yeah. So if I'm allowed to add something to that, being faced being in an interest rate low environment, artificially low, I would argue, and at the same time faced with a liquidation period, a short liquidation period of 7 months, because we have to liquidate the fixed income 6 months at the end of March. Initially, it was a headwind for us. We wanted to find fixed income securities instruments, so bonds, corporate bonds in this case, that had a low duration, low time to maturity, which we did. Ideally, they would be the same, but which we did. And what we didn't expect is interest rates dropping from 2.8% in September last year to 1.8% last time I checked.
You wouldn't have heard that from me. I didn't expect it either.
Yeah, so we did not expect that.
I go out of my way not to ever sort of make a call. But I've been preaching interest rates are going to go up for like 3 years, and I'm getting tired of being wrong. But and so what it means is that this Zions Bank fund actually has done well because interest rates have dropped.
So we did not. So that was a good positive story for us. Right. We capitalized on some of those gains. Right. Interest rate drops, and we know what happens to the bond prices.
The opportunity cost on this money is the 25 basis points that Zions Bank could get at the Fed.
That could get at the Fed, yes.
So we're gonna add a lot of alpha.
Yes.
In the
that's what we're trying to beat there.
Right. Trying to beat 25 basis points.
Very good. So interest rates is one of them. So what could be another headwind?
The big thing this it's oil. Just is amazing. Who would have imagined that we would see oil going from $100 a barrel down to $50?
What a story! Something I've never seen before. So in June last year, a barrel of oil, crude oil, was trading for 110, 115, 60% drop today, up to date, of 51 last time I checked today. And that could, like you were saying before, that could be good or bad. In the economy as a whole, it's a good story, but consumer discretionary spending, increases when that happens. But when you sit on our position,
right,
when we're sitting on energy equities in our portfolio, we have tuned in on these conference calls, and these companies will talk about slashing, their capital expenditures. And what that means is adjusting.
Meaning the oil companies.
The oil companies, yes. So that what they want to do is adjust their production capacity to match demand, because part of this story has been global supply, global and U.S. oversupply, and then not so much demand or demand being intact, and that reflects in lower prices. So it's been a challenge. We have a position in energy of 5.7% total of the fund, and so we have two positions. What we have done, though, I have some conviction that calling the bottom on the oil prices or on the Brent crude, and made an investment in one of our positions, which we sit on a gain on that second lot of buy. So overall, the cost basis is still negative, but I think we're pretty good allocated. We've done some reshuffling.
We are, and that'll be one of the things the students can brag about when we report it at the end of the year. But there was an intentional decision to try to. It's not just performance again; it's performance against the S&P 500. There's intentional decisions to try to exploit the change in oil prices, and turns out we were right. So you were right.
Yeah, we'll see. All right. So what would be another headwind?
A big thing that a lot of corporations are talking about lately is the exchange rate. So the dollar is so strong, and even though we focus on domestic equity, many of the companies that we're buying are multinationals. And even today we had a phenomenal report on a company well, the context was they're not whining about the fact that they're not getting the profitability they would out of Europe.
Right.
The euro dollar, the dollar's worth about the euro's worth about $1.13, 17 cents. I was in Europe a couple of years ago, and it wasn't there. It was
down from 1.37, right?
Yeah. So, in fact, given all the shoes my wife bought, I wish it would have been 1.13 or something.
Back then. Yeah. So aside from the economic downturn in Europe and a deflationary environment, we know that the ECB, European Central Bank, announced a quantitative easing program similar to the ones that we had in the United States not long ago. So aside from those two, which are definitely headwinds, the currency exchange has been a factor, a negative factor. So we have positions, like you said, in multinational companies, conglomerate companies that have heavy exposure to Europe, to European market.
Well, and Europe and Asia. In other words, the dollar is strengthened both against the yen and the euro.
So the business is good in general, but all of a sudden, when they report in dollars, the the net income below the line, the other comprehensive net income, that all of a sudden does not look good, and that's definitely a headwind there. But Professor Thorley, any so I think these three would be a major.
These three being interest rates, price of oil,
and then exposure
to
Europe,
and then exchange rates. Yeah, I think so.
Well, great. Thanks so much, Professor Thorley. It was a pleasure to have you today. Thank you for following us, and we'll see you at another Marriott MBA today.